The Federal Reserve leaks their plan on inflation in 2022. The Federal Reserve on January 26th signaled plans to begin raising interest rates soon, possibly in March, in a bid to tamp down inflation before it poses a serious risk to the U.S. economy. A separate report released the next day showed the economy grew 6.9% in the fourth quarter of 2021. An interest rate hike would be the first time the central bank has increased its benchmark lending rate in over 3 years. Welcome back to Investor Secrets. Today we're going to talk all about what the Federal Reserve leaked on inflation and what's their plan on inflation. So watch the video till the end because today's video is going to be the bomb. Now let's get to our topic. Number 1. Why is the Fed raising interest rates? Short-term interest rates in the U.S. are now essentially zero. The Fed quickly cut rates to zero at the beginning of the COVID-19 crisis in March 2020 in an attempt to soften the blow of the sharp recession that began that month as the U.S. went into lockdown. As a reminder of how bad things were back then, over 40 million workers, a quarter of the American workforce, filed for unemployment in the first few months of the pandemic, a staggering number with no precedent in the job market. Although the recession was short-lived, lasting only 2 months, and the economy has mostly recovered, the Fed has kept rates at rock bottom because many workers and businesses still need support as the pandemic continues to rage. The big problem for the Fed now is that U.S. consumer prices have surged. For 10 months in a row, inflation has been above the Fed's 2% target and reached an annual pace of about 7% in December. This is the highest rate of inflation recorded in the U.S. in the past 40 years. High inflation means the prices people pay for goods and services are continually going up, especially for basic items like meat and gasoline, as well as for manufactured goods like cars. The Fed can ill afford to allow this to continue because if higher inflation becomes entrenched, it would damage the economy. And the longer it lasts, the harder and the more painful for consumers and businesses it's going to be to bring it back to a more sustainable 2%. So the Fed has to act quickly before it's too late. Number 2. How does the Fed raise rates? The Fed sets a target range for what is called the federal funds rate. This rate acts like a benchmark for all interest rates in the economy. While the Fed statement didn't specify a time when it plans to raise rates, Chair Jerome Powell said the committee is of a mind to raise the federal funds rate at the March meeting, assuming that the conditions are appropriate for doing so. Analysts expect it to be a 0.25 percentage point increase. This would affect banks' cost of borrowing, which in turn slowly filters throughout the economy as lenders charge more for loans on homes, cars, businesses, college tuition, and anything else you might want to buy with debt. Banks would also gradually increase the interest they offer on deposits and savings accounts. The Fed does not directly control all these other rates, and the exact path they will take is not completely predictable, but the overall trend will be up if the Fed keeps raising its target rate. Markets expect the Fed to raise interest rates at least 2 more times in 2022. Number 3. What does that mean for consumers and businesses? Put simply, higher interest rates means borrowers would need to pay more for the loans they get. If the Fed lifts interest rates this year by 0.75 percentage points as expected, this would translate into about $45,000 in additional interest payments on a 30-year, $300,000 mortgage. So if you want to borrow to start a business, pay for college, buy a car, or do anything else, you should expect your borrowing costs to be higher later this year. On the other hand, higher rates is good news for savers and investors as their returns from activities like making deposits and buying bonds will go up. Number 4. And how will it affect the broader economy? Higher interest rates would likely slow down business activity. While this can help reduce inflation, it also means lower economic growth. The Fed always makes decisions based on what's happening in the economy and how the economy conditions are expected to change, and changes in the economy are often hard to predict. The biggest unknown at this point is what will happen to inflation later this year. This is uncertain because inflation is driven by multiple factors, such as supply chain shortages and strong demand. In addition, the labor force participation rate has still not recovered to pre-pandemic levels, and the economy is experiencing labor shortages, which could push wages and prices higher. If these COVID-19 related pressures don't ease up soon, inflation could continue to stay high or continue to accelerate, which may force the Fed to increase interest rates faster than currently expected. On the other hand, if economic or employment growth stalls, this will make it much harder for the Fed to raise rates without making things worse. The Fed will need to find the right balance between taming inflation and avoiding slowing down the economy too much. Supporting jobs, fighting inflation. In addition to rate hikes, the Fed also is tapering its monthly bond purchases, which have added more than $4.5 trillion to its balance sheet since the early days of the pandemic. Officials also have indicated they will start decreasing the balance sheet later this year, most likely by allowing a set level of proceeds to run off each month, though the Fed also could sell assets outright. Powell said the moves are in response to an economy that has both a strong jobs picture, with an unemployment rate at 3.9% in December, but with inflation expected to top 7% year over year for the same period. What that's really telling us is that the economy no longer needs or wants the very highly accommodative policies that we've had in place to deal with the pandemic and its aftermath, Powell said. We are really just going to be moving over the course of this year to a policy that's closer to normal, but it's a long road to normal from where we are. He faced some questioning about why the Fed got its inflation call wrong, and he again cited issues mostly related to the pandemic, which has seen clogged supply chains, sparsely stocked store shelves, and rising prices that Powell said could threaten the recovery. If inflation does become persistent, if these high levels of inflation get entrenched in our economy and people's thinking, then inevitably that will lead to much higher monetary policy from this, he said. That could lead to a recession, and that will be bad for workers. Powell also faced questions about a controversy in recent months over the financial activities of several officials around the time the Fed was about to implement a series of rescue measures just before the pandemic declaration. Fed Vice Chairman Richard Clarida announced Monday that he's resigning a few weeks ahead of the end of his term, following additional disclosures about his buying and selling of equity funds. Regional Fed Presidents Eric Rosengren of Boston and Rupert Kaplan of Dallas resigned in 2021 following similar disclosures. Powell said the Fed soon would be publishing rules that would prohibit similar activities without 45 days' notice. The old system was in place for decades, and then suddenly it was revealed insufficient, he said of the prior rules. If you guys enjoyed this video or think it was valuable, then don't forget to hit the thumbs up, subscribe to our channel, and hit the bell icon to get notified first. Also, feel free to let us know your thoughts about the next video in the comment section down below. See you soon. Bye.